All right, we've been given the official green light to get started. Good morning, everybody. This is Jonathan Coppess with the FarmDoc team here at the University of Illinois for our webinar. Gary
Schnitkey here, and what we're going to be doing is go over the topics that we said we were going to do, but just a little update here. This webinar will be archived at the place that you see on your screen. We do have our handouts available, and they are on the webinar control panel, and those are available right now. So if you want those as we're going through it, those are available. And then as we're going through this, we will answer questions as we go through it. So we have a number of questions here, and we'll try and get through as many and all of them as we can, give as many answers as we can at this point.
Yeah, and just for those of you not familiar with it, every one of our webinars are archived on that site. And so if you want to go back and see some of the previous material, YouTube, ability to review any part of it, it's all there. So just in case you have to step away from something here this morning. But again, we're going to talk ARC and PLC, the Agricultural Risk Coverage Program and the Price Loss Coverage Program, as reauthorized by the 2018 Farm Bill and now officially up and running under the Farm Service Agency's regulations. And we'll touch on a little bit of MFP, the Market Facilitation Program, and the supplemental prevent plant. So Gary, do you want to get us started? We want to reference a couple of FarmDoc articles.
Yeah, so agricultural risk coverage and price loss coverage, that we do have a couple articles up on FarmDoc Daily. September 24th and September 27th. September 27th, agricultural risk coverage county level. This past week, PLC. And we will have, next week, we'll be choosing between ARC County and PLC. So that will be the Tuesday article next week. And the week after that, we will do ARC IC. So those are a schedule. And again, you see our online payment evaluator there available. On Farm Bill 2018, again, the decisions are the same as last time on each FSA farm. There will be a choice between PLC, price loss coverage, agricultural risk coverage, county level, and ARC IC. And the big distinction there is you will be able to choose PLC and ARC County on a covered crop basis. So you could make one decision for corn, one decision for soybeans. And then if you choose ARC IC, it applies to all crops on that farm. So ARC IC is sort of the decision point that of those combined together. We today are going to spend all of our time talking about PLC and ARC County. We will deal with ARC individual coverage later on. For the Midwest, at least, most people we think will be choosing between PLC and ARC County. So, and actually our decision process will be you choose the best one of those for your crop and then think about ARC IC after that. Last time, everybody chose ARC County, and you can see there are bars there, corn and soybeans. Over 90% of the base acres were enrolled in soybeans and corn in ARC County. I would not make that assumption this time. I don't know. I would be shading more to PLC, although this year we got to wait and see what those county yields are. So,
yeah, I mean, given where prices are projected to go and that fixed level of price support, price-based assistance in PLC, it's hard to come up with a scenario, at least in the next couple of years. And this is maybe the key point and the key difference between this decision now and the decision you made after the 2014 Farm Bill. We just always want to remind that in 2014, you took a 5-year decision, and that was locked in for all 5 years, whether you took ARC County, PLC, or ARC individual. This time around, that decision is a 2-year choice. So what you decide, and that the deadline for making this decision isn't until March 2020, but the decision you make by March 2020 is for the 19 crop year and for the 2020 crop year. So it is just a 2-year lock this time, and then you'll be able to revise that decision each of the following 3 years that this Farm Bill is in operation. So one big aspect of the decision to keep in mind, that you're really looking in this first time just for the near term, the first couple years of this program and what the price forecasts look like. And so I think that to Gary's point there, that's a big factor in why PLC is expected to get the bulk of the sign up this time around.
And again, the deadline sign-up will be March 15th, 2020, which will be halfway through the marketing year for 2019. And we should also have some pretty good idea of what county yields are at by that point in time. So at least the 2019 choices will be in pretty clear focus, and then we'll be focusing on the 2020. So again, March 15th is the deadline for making these decisions. Price loss coverage. So now we're going to talk about price loss coverage in the Nark County. So price loss coverage, it's a relatively straightforward program that hasn't changed a lot from last time. It makes payments when the market year average price is below the effective reference price. And that is the change, the effective reference price. And we'll talk about what that means as we're going through that. Again, market year average price is a national average price. It begins its calculations for corn and soybeans in September. So we're working for the 2019 crop year for now. So that marketing year began September 2019, or this month, and it will end in August 2020. So January 2019 will be roughly halfway through that. So we should have a pretty good idea of what the market year average price is for corn and soybeans, and wheat runs from June to May. So we'll have a better idea as well.
Which is probably our first bit of advice on this is there's no rush to make this decision. That in fact, waiting closer to the March 15th deadline, you're going to have a lot better idea where prices are and where they're headed. We'll have a new round of forecasting even for the 2020 crop year, and some idea maybe even of planting intentions. So this is not a decision that anybody needs to be in a hurry to make. You got time to think it through and see where things are headed.
Yeah, and you can go begin the paperwork at FSA and start the process and maybe get the yield update done, as we'll discuss later on. Again, we have a new effective reference price this year, which is the higher of 85% of the 5-year Olympic moving average of market year average prices, or our statutory reference price. And our statutory reference price is corn $3.70, soybeans $8.40, wheat for $5.50. For all intents and purposes, you can ignore the 85% of 5-year moving average, particularly. Well, you can ignore it for corn, soybeans, and wheat for making the decision for 2019 and 2020, because there's no way that the 85% of the 5-year Olympic average will be above the statutory reference prices. So, and to get a higher effective reference price, Olympic average would have to average above 435 for corn, not likely, 988 for soybeans, not likely, and 647 for wheat, which again is not likely.
Yeah, and here again, this was a feature added in the 2018 Farm Bill. This pulls the 5-year Olympic moving average that we use in the ARC program and plugs it into the PLC program. And really, this just operates as an upside escalator provision, right? There's no downside because you don't fall below. PLC's price protection doesn't fall below the statutory reference price. But if you have enough years of a higher price, which is Gary's numbers down here, the 435 for corn, or you see this chart here, the key is that it's going to take it. Again, it's an Olympic average, so you drop the high and the low, which means you have to have at least 2 years of a pretty impressive price movement upwards to even begin to trigger this kind of factor. And then it really gets into this a much tougher comparison with that in Ark County. But if you look down here at this chart, what FSA is saying for 18, projecting for 18, and then CBO's projections out through 2023, none of these forecasts right now are showing prices anywhere near that kind of upswing that would trigger the effective reference price. So really what you're looking at for the PLC side of this decision is simply whether forecasts are going to be below that statutory reference, because it's going to take at least 2 years to pull that above. So really we're talking about the 370, the 840, and the 550 trigger prices for PLC. and we've got all of the reference prices and loan rates. One of the things we don't mention a lot, and we've not talked a lot about the marketing assistance loan program over the years because prices have been so far above loan rates for most of the Midwestern commodities. A couple things just to keep in mind on price loss coverage. The loan rates, first off, the loan rates were increased by some fairly decent amount. We went from $1.95 to $2.20 on corn, for example. That national loan rate comes into play in PLC because if the actual market year average price falls below the loan rate, it's the loan rate that plugs in as the market year average price. So really, this is the bottom end of PLC. Once you go below the loan rate, then the loan rate kicks in and PLC stops. And so you can think of, for corn, for example, your coverage range on prices is from 370 down to 220. If it goes below 220, and we don't expect it and certainly do not want to even contemplate what that looks like, but should it fall below that on a national market year average, then 220 is the price that's plugged into that, and then you'll get the deficiency on the up to from 220 up to 370. So just kind of keep that in the back of your minds. That changes the program a little bit, at least with a higher loan rate, but that feature has always been a part of these target price programs. So you want to jump ahead, and we'll again, just another sort of reiteration of where using chief economist forecasts and what it would take and how this sort of Olympic moving average component works. Here again, this is soybeans in particular. They're just not going to be, there's not the expectation of this price movement pulling this up at all. So particularly considering we're making a decision for 19 and 20 is the only 2 years you have to worry about this right now. There's no way. The escalator provision will not actually impact the decision at all because you would not have enough of a price movement for multiple years in order to do so. It would have made a difference. For example, if we went back to 2013 and 14, if we'd gone back in that and had this provision in there, it would have made a difference then. It's not going to make a difference now.
An important thing to remember here is that the market year average price is a cash price. It's a national price, and it's calculated by National Agricultural Statistics Service. So that market year average price, when it's kicking in, it is based on a national price. So obviously there's quite a bit of variability in prices around the country, and that market year average price is a national average.
Right, and it's the price they receive. The farmers receive. Yes. So it's at the farm and elevator level. And again, another reminder, frankly, of the incredible work that the folks at NASS do, and how important that information is in operating these programs and helping us understand the risk factors and how these programs are analyzed and understood. And just a reminder of that as NASS and some other aspects of USDA go through a tough stretch here, their work is incredibly important.
So the other thing about the PLC program is that there will be a yield update allowed for PLC. And this is one of the things that if you want to get to work on the 2018 Farm Bill is getting the farm yields for each one of the FSA farms around and seeing what those will be. The decision will be on a crop and farm basis, so you could choose to update yields for corn on one FSA farm and not update soybeans, or corn, soybeans, and not update wheat. And frankly, the decision is simple: pick the higher number. So look,
I like that you look at me like, this is a decision even the lawyer can make, right? And understand. Take the higher yield, and you're done.
You're done. So there is a current PLC yield for each one of the farms that exist with FSA based acres. Calculate the 2013 to 2017 average, and that will be multiplied by a factor. Over to the right, you see all the factors listed. Corn is 0.81, soybean is 0.81, wheat is 0.8591, and then the rest of the crops are listed, and you can see they range from 0.81 to 0.9. So corn and soybeans are at the low end, 0.81, and that happens to be because were the ones with the highest yields relative to the.
This is one of my favorite features in the 2018 Farm Bill programs. This ratio of a ratio concept.
and that
which
peanut-
really is really designed to hide the fact that different crops get a different update factor. But as Gary said, corn and soybeans are getting the lower update, so it's really a 0.81 of the 13 to 17 average. So 0.81 multiplied by that average of 13 to 17. There's plug yields in there for any year in which you're below the plug. And again, if it's a higher yield number than what you currently have on record, you take that. And I think Gary's got good advice on this about use your crop insurance yields. If you have them, that's your best record. That's going to be your best method for determining what that yield number should be. And USDA, FSA, and RMA are working quite a bit to sort of bring all those records and everything together. So I think harmonizing that is going to help a lot. And I think for the farmer, it's going to make life a little bit easier to have to just deal with one set of yield records.
And frankly, you got the records already, so why reinvent the wheel? This does bring up another important point. You will be allowed to update yields. You will not, and repeat, not be allowed to change base acres at all. The base acres will stay the same for each FSA farm. They will stay the same to the ones they have existed. We were allowed to have a couple options under the 2014 Farm Bill to keep them this time.
Yep, there'll be no reallocation, no update. The base acres stay exactly as they are currently on record.
So this will give you an example of what that calculation might look like. And this is for a Champaign County, Illinois farm. And we took the average yields for Champaign County just to give you a feel. And obviously, this is a farm yield. We are using here the county yields, but they are farm yields. But we're using those average yields just to give you an example here. The update process, there will be a plug yield, which will be different for each crop and each county. So there's plug yields for each county, and pick the higher one. And in most Illinois cases, in most cases, the actual yield will be higher than the plug yield. Take those and average them. My average here in this case is 198. And we're going to take 0.81 of that. So this farm, if they had these farm yields, would have an update yield of 160.5. Again, compare 160.5 to the existing yield and choose the highest. So we're now going to move on to Ark County, and you want to go over these changes?
Sure, we'll run through some of the changes. Again, the 2018 Farm Bill largely just reauthorized these programs and continued them and just kind of made some tweaks around the edges. But some of these will make a difference over the longer run here, and so they're worth just taking a few minutes to think about. So again, Ark County is the revenue-based program. It is county average yields multiplied by the national average prices.
Just by the way, we got two questions on PLC yields that we're going to answer. They're actual yields and they are not trend adjusted.
That's right. Yeah.
So when we're doing this this update right here, these farm yields, they are actual farm yields, not trend adjusted.
Yes, that's right.
So thought we would get those before we moved on. Go ahead. I'm sorry for interrupting.
Well, that's a good, that was well timed, Gary, because we're going right into the yield calculation for our county. So like I said, it's a revenue-based program. You're using the 5-year Olympic moving average of county average yields and the 5-year Olympic moving average of the national marketing year average prices. That gets you the benchmark. 86% of that is the guarantee. So if you fall below 86%, that's when you trigger the per acre revenue-based payment, and then that covers for 10 points off the benchmark. So it goes from 86 down to 76. That is all the same as it was in 2014. The big difference, to Gary's point about yields and question about yields, is we do have the potential for changes in the Ark County yield side of the calculation. And this actually is one of those, we learned a thing or two in operation of this program. The first one is that while prices we see move up and down, and that Olympic moving average is designed to kind of smooth out some of that volatility and create a program that is working outside of just the rough movements and volatility of the market and give you a smoother kind of system. Yields operate differently, right? We found this in some of the challenges from county to county and other issues with 2014's operation. And what Congress did this time around was to allow for trend-adjusted yields to be put into the Ark County benchmark calculation and the county yield calculation overall. And so this is the same trend-adjusted yield that you use in crop insurance. It will come from RMA. It's calculated the same way. And basically what this does is this acknowledges in the guarantee for Ark County that we expect yields to improve. We don't expect them to move up and down in sort of volatile nature. So when you're designing a revenue program, you want yields that reflect what the expectation is for that farm and that county. So going forward, starting at the bottom of the slide here, we know that we're going to be using trend-adjusted yields for calculating the Ark County yield portion. There's also a slight increase in transition yield or the plug yield up to 80%. So any year that's below that, wait a minute, we just jumped.
Oh, I'm sorry.
I was moving from the bottom up. RMA yields are the primary yield function used in Ark County this time. So this does address one of the concerns last time about the way whether it's NAS or RMA yields. This time around, RMA yields are the priority and primary yield used for the calculation. And one other fix from the last time around is this top component here of county location. There was a bit of a controversy when FSA rolled out a administrative county. That has been changed officially in the statute. It was changed at the implementation level before, but it's now in the statute. It specifically states that payments are on the county where the farm is located. So the administrative county is no longer determining the payment. You may still be working in the administrative county with FSA, but the Ark County program will be determined. The payments will be determined on yields in the county that farm is located. So just a couple of the quick fixes to this program. Also in Ark County, as you recall from last time, probably the PLC reference price is the plug price in the revenue calculation.
By the way, just as Jonathan's gone over this, we will give an example of these calculations. So
we'll run through this, and we're going to run the estimator tool on it as well. Calculators. The effective reference price in PLC remains the plug. So that means that 85% escalator provision could also potentially impact in the Ark County decision, because you're going to use whatever price you're using, frankly, in PLC as the bottom price, as the plug price in Ark County. So it will replace any price below it in the 5-year calculation. So just you keep that in mind. Again, this provision isn't going to have any impact on the 19 and 20 decision. It's highly unlikely it has any functional impact over the 5 years.
By the way, when we say that it's on corn, soybeans, and wheat, there are some oil seeds where they will have this the effective reference price will. So
good point. We're speaking largely from the three main crops: corn, soybeans, and wheat. But for those others, particularly the oil seeds, that's a good point to remember that you want to see these individually. Another feature, another difference in the 2018 program is we have a lag in our calculation. So we're back a year. So instead of waiting out or trying to have some uncertainty around what that year price will be, the benchmark starts back a year from the year we're in. So that will help. I think the big key for lagging this 5-year by a year is that we will have absolute certainty what the guarantee looks like, and have a better sense of that. We mentioned the multiple decision points again, that you've got till March 15th to make the decision. That's a 2-year lock, and then you've got a chance to make this decision each of the following 3 years. I think let's move through some benchmark calculations here. Gary, do you want to?
Yeah, so I'm going to go through some benchmark calculations. And again, this is for information purposes. In implementing this program, you would never have to do this. So this isn't something that individual signing up for ARC County or PLC would do. And in fact, FSA can tell you what your benchmark revenue is for a county at sign up, which is the reason why we have these yields and prices lagged.
And that might be the first thing to just note here, that when we say lag, so going in for the 19 crop year, the 5 years used are going to be the 2013 through 2017 crop year, not 14 to 18.
Yep.
So we're backed up a year now in that benchmark calculation.
So, and again, we're going to do this specific calculation. This is for Champaign County, Illinois, the place where we're located at the center of the world, as far as we're concerned at this point in time. Sorry to everybody else, but we're here right now. This is for non-irrigated corn. And another thing to note about this farm bill, or this sign up, there will be many more counties with irrigated and non-irrigated time series. So just to note that there will be many more of those. We will be making, and again, this is the 2019 year, and we'll be using yields and prices from 2013 through 2017. This is the lag portion. We will not be using 2018. And the reason why, again, you're doing this is because when we're signing up for this, particularly when you're making those yearly decisions, you will know the benchmark yield, the benchmark price, and the benchmark revenue. These happen to be the county yields for Champaign County. We will be putting all of these on a spreadsheet and making these available on FarmDoc daily for next week. You can also get those from FSA website. There will be a plug yield, 80% of T yield, which was 140.8 for first several years and 145.6 for 2017. And in our calculations, we will use the higher of the county yield or the plug yield. And in Champaign County, as it is with most counties in this time period, in Illinois at least, the 80% of yield does not come into play. It would have come into play if we had 2012 in it, but we have 2013 to 2017. Again, so these are our yields, and again, higher of 80% of T yield or county yield, and this will be trend adjusted. This trend adjustment, so 2013 is 6 years from 2019. So if you go back, it's 6 years from 2019. 2014 is 5 years, 4 years, 3 years, and then 2017 is 2 years. Take that yield times the trend adjustment, which is 1.71 for Champaign County.
And Gary, that 1.71 is the RMA number. Is that correct? Okay, so that's where we know the RMA component comes into that. So each county is going to have a different one.
By the way, these are RMA reported yields. These are not NASH yields as well.
Oh, okay.
So there's two changes here. County yields, so last time around, these were NASH yields. This time around, they're RMA yields. There are slight differences, not much in Illinois. 6 years times 1.71, 10.3, and then when you get your trend adjusted yield over here. Again, you don't have to make these calculations. This is just for you nerds who want to know this. This will be the benchmark yield is then 219.5, and you throw out the low 193.7, throw out the high 236.3, and average these three to come up with 219.5.
And that factors into your guarantee, your benchmark, which factors into your guarantee. So that will improve to some degree. Will improve the ARC County guarantee. And again, I just want to make sure that 1.71 that changes for every county, because each county has a different trend adjustment factor. So this will vary from 1.71. I misstated there. 1.71 varies by county and crop. So yes, don't use 1.71 for your calculations. Again, these are on the FSA website. Yeah, and that's a good reminder. If you haven't visited, FSA has they have posted there's a lot of great information there on the Farm Service Agency website for the ARC and PLC program. They've got data going all the way back. So if you really, like Gary said, if you really want to geek out on this and see some of the numbers yourself, FSA has provided all of that, and it is available. It's what we're using, frankly, in the online calculator. So for those of you that like to do your own calculations, that information is all available.
Yep, and we're just giving an example here, so you know, there is actually the calculations are transparent, so you can know what they are.
Yep.
We will do the calculation of benchmark price for corn 2019. Again, this is going to be the same for corn everywhere, 446. We take the market year average price. It's plugged by the effective reference price, which in this case is 370. So you can see here we are using in our benchmark calculations, as it would be under the old farm bill as well. 370 gets plugged for 2014 through 2017. We throw out the high 2013, we get 370. Again, this is the 2019. We're not including 2018 data in here. And by the way, 2020 cannot, and I repeat, cannot be over 320, because if 2018 market year average price is above 370, which it wouldn't be, but let's say it's even $5, which it won't be, it would get thrown out.
Yeah.
So the 2018 is going to be the 2018 plug price will be 370, and then we'll see what 2020 price is, but it's going to be, even if it's high, it's going to get thrown out by the market year average.
And this is a great sort of reminder of just how different these programs look compared to 2014. Because if I remember right, we went into 2014's decision at a 529 benchmark price for corn. Right. So we were at a much higher level that incorporated those higher price years leading into the 14 farm bill. So, just one of those kind of comparisons between last time and this time. We are now talking about a benchmark that is calculated using the PLC statutory reference price, not because of the price scenario of the last few years. And that is just an entirely different component than what we saw in 2014 when we were up at 529. We had 2 years. The first 2 years of that 2014 farm bill had a 529 price in it. So when we talk about why PLC looks like the more favorable decision, this is a big part of it, because this ARC program adjusts over time, and it has adjusted down to this lower price level.
And the one thing, again, I'm going to tell you to wait a little while, because remember also, this is our benchmark yield for Champaign County. If Champaign County comes in at 190, we could be kicking in some payments here on Arc County. So, but we'll get, there's no reason to speculate on that yet.
Yeah.
All right.
But a good reminder that unlike PLC, Arc County does respond to a low yield scenario. So it does have that feature to it that PLC doesn't, which needs to be factored into the decision, even if it may take a pretty hefty yield hit before you start to trigger.
This effective reference price is calculated the same as under PLC. So yes, the calculation is the same.
Right. And that 370 is a statutory reference price, because again, the escalator provision is not going to do anything in the next couple of years.
By the way, these explanations are online. This is actually our FarmDoc Daily from 2 weeks ago. You see this was September 17th. So if you want to geek out on this and look at them some more, go to that point. Our benchmark yield, benchmark price, enter into the benchmark revenue calculation. That's a simple multiplication, and then we take 0.86 of that to come up with our county guarantee. So there's our guarantee. And then if county yield and market year average price, and I put here, this might be our 2019 county yield and market year average price for this year. 665, we would be getting a payment under our county. The payment, it will be the difference between the guarantee and the county revenue. And that will be taken times 0.85 because it's a payment on a base acre basis. But let me just go through this. So we have our guarantee, county yield times market year average price. We do not know either one of these. So, and this actually might be estimated at 360 right now. County revenue, and then then our maximum county payment rate, and this is also as important, is 10% of our benchmark revenue, which is on the previous slide. That's important because these payments will often get capped. So just remember that there is a cap on our county payment, and it's 10% of our benchmark revenue. Our payment rate in this case will be county guarantee minus county revenue, and that is less than our maximum county payment rate, and then we take that point times 0.85, which is the same as their calculation.
Yeah, so that 0.85 there, not to be confused with the guarantees, 0.86. This final 0.85 means on both ARC County and PLC, whatever the payment rate is, you get it on 85% of the base acres for that commodity on that FSA farm. That is, again, a statutory provision that leaves 15% of those acres out of the program. And so what Gary has done here is just adjusted that 3345 down to represent the fact that 85% of the base acres are the only ones that get a payment.
There is one other difference, as one of our questioners point out to us. SCO, supplemental coverage option, which we won't be discussing today, is not available if you take ARC County. It is available if you take PLC, which may, again, if you're pretty close to those decisions points, you might think about taking PLC if you take SCO. When we're going to now show how we calculate expected payments from both of those, ARC County and PLC, which we think will be a big decision. One other point, there's two other points I would make about the decision. SCO is not available for ARC County. And also ARC County has this maximum payment rate, which cuts off a lot of payments. And if we have like $3 corn price, PLC would make much larger payments than would ARC County.
Yeah, but another thing, just sort of remember on that while we get the tool up and running for everybody. SCO is a crop insurance policy, and it's a supplemental crop insurance policy. So your underlying revenue coverage. So if you buy up to 85% revenue, then you can get SCO only from 85 to 86% revenue. So it is a supplemental, and it's determined by what you have as underlying coverage, and it's a top off to that. As crop insurance, it will go on the crop you plant, not the crop with base acres. So there are some important differences between SCO and ARC County, but because they do have enough of a similarity, you cannot get both on the same acres. And that's the same situation we had in 2014, so that has not changed. What is different now is that the sort of reverse situation between ARC and PLC in terms of where prices are. So just kind of keep that in mind. We'll have more information on SCO in the future as we look through some of the components of that. But for right now, the key to remember is you cannot get SCO and ARC County on the same crop. And the SCO is a crop insurance supplemental program, not an FSA Title I support program. So Gary has pulled up the FarmDoc Gardner payment calculator. And this, again, just as a sort of a plug for our partners here, we have worked very closely with the incredible group of programmers at the National Center for Supercomputing Applications here on campus to design this calculator and run it online. Gary and the team have put together the modeling capabilities, and NCSA has made this work in the ether of the World Wide Web. And so you can go there, you can find it linked on FarmDoc on the Gardner page. We had the web link there before. we are still operating in this trial, what we call the alpha release, the sort of initial release of this, as we are continuing to complete the development. We've just sort of pushed out an alpha to give you a chance to use it. It's a tryout period, so you don't have to come up with login and all of that. But soon we're going to be rolling out the final version, in which you will have to do a sign up, your username, login, which will allow us to keep everything secure and keep out the hackers and the other nonsense. Not that it's not secure now, but it's to get everybody using it. This is one secure system now, and then eventually you'll have your own login capability and account number in this. So,
and that's coming. That is coming very soon.
Yeah, our hope is early next month we'll have that running, which is I keep trying not to think that we're at the end of September,
which is soon, by the way. So what we're going to do is show you the calculation, and we'll go through.
So again, this is a pretty standard feature from before. You select your state, you select your county, and here we're staying within the great state of Illinois, and you going to McLean?
McLean, we'll do McLean County. By the way, you could
also just hit the end.
Yeah, I should have done that. We choose Illinois examples because they pay our salary.
Then you pick your crop, and still we are updating this with more crops and more data as we go. That's part of the final release as well. But so right now in this trial period, you've just got corn, soybeans, and wheat. Gary, you want to talk? Same thing we did last time, and that I think is an important way to use this tool is that you have the option of picking a price series, and these are different forecasted price levels to run the tool against. So you get a sense of what happens if we're in a higher price scenario, such as the $4 scenario here.
Yep. So we have a forecast series, which is our best guess of the prices in the future. We have no particular crystal ball better than anybody else. We also put a high price scenario in there, which the high price scenario, if you're looking at high price scenario, will favor Ark County. So the higher the prices, the more you look at Ark County. The lower the prices, the more it's going to favor PLC. And then we have CBO prices in here as well.
And that, just for those that aren't familiar with the terminology, CBO is the Congressional Budget Office. They're the nonpartisan independent economists for Congress that score programs and estimate outlays and whatnot. They have a very good price forecast because they're using kind of all available information to get to that forecast. So they're using USDA forecasts, they're using other academic forecasts, and that's just another nice. Nobody has a crystal ball, but they're another version of looking into the unknown future.
All right, so we run the model. We had a question while we're waiting on this. Are Ark County and PLC subsidized like MPCI is? Well, Ark County and PLC are total subsidies. So,
I mean, in a sense, yes. There is no cost. There's no individual cost to the producer. They are simply, other than time to sign up. There is no out-of-pocket
cost.
Payment.
Yeah. The one thing we should mention too is that farmers and landowners should make a decision. It's important to make a decision by March 15th, because otherwise you won't get payments, right?
That is correct. You got to go in and sign up and get the contract entered with FSA in order to get these payments. That's the requirement. You got to have base acres. You got to have the records on file with FSA, and then you got to go in and sign the contract and make your decision. This isn't automatic in that sense. A question came in, is this Apple computer friendly? And we are running Apple computers right now. So the answer is yes. This actually should work on your iPhone. I was going to say, this is not only Mac friendly,
but iPhone or any phone, actually. Phones and any phone is designed to fit on a phone. If you see a phone, you'll see this slide first here, and then you'll have to scroll down, which our lawyer here didn't know how to do the first.
You did not. That did not need to be brought up again.
All right, so we have a 2019 projection here. So this would be our projection for Ark County payments and PLC payments at this point in time. And that is a crucial number here. And we'll talk about that. We are going to be updating the prices and the yields in here, and we'll be able to narrow in by December. We will have a much better look at these prices at these payments. So we would be projecting a $16.44 payment for Ark County at this point in time, $39.15 for PLC. You can look at this as a bit like a weather forecast. Right now, we are saying that the market year average price is going to average $364, but it could be above it and could be below it. We built in that variability into this price projection at this point in time. Again, it's somewhat surprising that how much variability there can be in the market year average price, 2019 market year average price, given what we know at this point in time. And if you're in agriculture, you sort of understand that, but that could be considerably below that or considerably above that, depending on market conditions. And we built into here historical relationships given the information we have today. 38% probability of a Ark County payment, 56% probability of a PLC payment, which actually says we believe that market year average price will be below 370, 56% of the time right now. And again, these numbers will go, these will get increasingly more accurate. Our likelihoods will be as we move through 2019. This is your favorite feature.
Yeah, I like this as a way to sort of understand what the model's doing. So we take that 374 or that 364 average, and you run 1,000 scenarios around it based on the historic relationships to get a sense of, what's the range, if you will. What are the odds, right? What are the odds that we're going to hit 364 and trigger this payment? And then we broke them out into a series of these buckets or bins here, and give you an idea of when we ran the 1,000 scenarios where each of those 1,000 scenarios fell. So as you can see, the bulk of these are falling in the 0 category, which means you'd be above 370 in PLC, or the Ark County guarantees above the 86% or the actuals above the 86% guarantee, and you wouldn't, you not see a payment in that scenario. These will change, as Gary was pointing out, as we know the prices and have a better sense of that. That's going to narrow the range in which this 1,000 runs will operate. But you can see then where they would fall should, and really what this means is when each one of those 1,000 scenarios, when you're below the reference price and then further below the reference price, right? So that's where those fall in. And that's how we get to our 38% Ark County and our 56% PLC likelihoods. It comes out of that scenario. So like I said, I like this as kind of understanding the odds before you and how to break those down. Gary, I like your weather analogy. This is our weather forecast. We'll be wrong somehow, some way. But this is the best guess you can have, not knowing what this future price and yield scenario will be.
The other point of this, the orange bars here are Ark County payments, or where they would fall, the percent of time they would fall in these buckets. So Ark County would be 202 cases would be between $45 and $68 per acre. You note that they don't have large payments out here at the end. PLC does. And what's happening here, this would be a bad scenario where we have PLC, low PLC prices. PLC would make much larger payments. There's pretty low probability of that, but those are out there.
And that's where you see that 10% cap. And that's exactly what that is. So the PLC payments bump up against that 10% cap. Before we jump to another crop, can you go? We had a question up here that I think is a good one that helps understand what's going on with this. It says run the high price scenario.
Okay.
So this is a good example of when we talk about running the odds, that we're looking at the odds of this, right? If the market year average price is $4, which is what the high price scenario plugs in, there would be zero chance of a PLC payment. However, what we're using is $4 as sort of the center point of the 1,000 scenarios around it. So simply put, yes, if the market average price is $4, there is no PLC payment. It's unlikely there's an ARC County payment. The reality is we don't know, if you hit that $4. So running this scenario will show some percentage of PLC potential payments.
So let's just go through that example. PLC, we have this is at our forecast price, which is at $364, $39.56% chance. Now we're going to run a high one. It's thinking back here, but I'll tell you. So our PLC expected payment went down,
right,
and our likelihood of payment went down,
and hit the distribution again,
and our price distribution.
And so if you compare that, right, if you look at that, the number that hit that zero bucket by far. So in this run here, we've got what, 700, almost 700 of the 1,000 PLC fall in the zero category.
Yep.
And that's what you'd expect. I mean, if we're around $4, of course it's not going to make a payment. But using a forecast price, we're trying to get a sense of the likelihood or the odds that we would see a payment. So again, these are, we're kind of presuming that the basics are understood, that at $4 there is no payment, but we're trying to make a decision into the future. And so if we think we're in a higher price scenario, it changes the potential. It changes the odds around that. And that's what you're seeing here. If you're above 370, there is no payment in PLC. That part is, like I said, we're presuming everybody is comfortable with that aspect.
So our next forecast run will have much lower soybean prices in it. So just so we know that. And again, I would really suggest waiting. This model will become much more accurate in December
for 2019.
For 2019, because we will have a much clearer idea of what the actual harvest looks like. So this is the run for, and actually you can see at this price we have a very low chance of either one of them making a payment.
Right.
And then if we go to a low price scenario.
What were your low prices in this?
We'll see right here. They'll put the low prices right here, $8.50.
So we're right close to that $8.40 target price, reference price, sorry.
And so we would give about a 50-50 shot of it making a payment at that point in time.
But a far smaller payment that you see in the corn side of the program. So that those components are going to make a big difference. And I want to stress a point Gary just made, which is we will know a whole lot more about the price scenario for this as we go into the new year. So the timing for this decision, you really want to wait this out and see what things look like.
So we had a question on the timing of these payments. Timing. So you'll be making the the 2019 program decision by March 15th. These payments, if they happen, will not be happening to October 2020. Right. So
all payments are delayed a year. Just always remember that. We're moving in different time frames. We lag the calculations and we delay the payments. But again, that's partially because you have to have a market year average price to calculate the actual guarantee and the actual number against the guarantee and the effective price to do PLC. So that takes the marketing year, and then a little sleight of hand by the congressional workers on this that's been around for a while now that pushes 1 year back into the federal fiscal year, which saves out year costs. So there is a delay. 19 payments will be made in October of 2020 and each year after that. We have a nice reminder. Again, we appreciate everybody from FSA who have tuned into this and always help us as we
get it right.
Sort these things out. And a great reminder from an FSA employee that you just, as a producer, you need to get into FSA and file your acreage reporting. You can still late file those, but acreage reporting at FSA is a key component. So when we say you got to sign up for the programs, you got to sign the contract, and part of that contract arrangement with the agency is that you will report acres and comply with conservation requirements and other things. So make sure you still do that and keep on good terms and and meet the deadlines at the agency level.
So we do have new market loan rates, which are higher. Again, those will enter in the PLC calculations. Let's just do a...
Yeah, before we jump off ARC and PLC real quick, a good question here. Does the landowner or the operator make the ARC or PLC decision? So the way to always remember this is if the decision impacts the farm going forward, it's the landowner. So the yield update, for example, is a landowner decision. Anything that sticks with that farm, regardless of the producer, is a landowner decision. The program decision, however, is the producer. And the producer makes that decision much in the same way as the producer that goes in and gets crop insurance. So it is that on a cash rent scenario. Now, if you are in a share rent, the landowner would have the ability, would be a part of that decision as well. But in general, it is the producer who makes the program election decision between ARC and PLC.
A couple other points. We will be doing additional webinars where we'll cover ARC IC. So if you're that will take about a whole webinar to discuss the intricacy of that program if you're so inclined.
And I think the struggle has been with ARC IC is that it's two things. One, you're working across multiple commodities on the farm, so it complicates your revenue calculation. And the other is that it pays on 65% of the base acres. So there's a 20-point discount on the payment number right off the bat, and it means there are just certain scenarios. They're kind of a narrow set of scenarios in which ARC IC can make sense. Doesn't mean that you shouldn't consider it, and it will make sense in some farms in some areas. But that's a pretty steep fall from 85% of the base to 65, and that makes a difference. With that, we'll jump into some of our non-farm bill new supplemental ad hoc, or whatever you want to call it. What name do we even use for these anymore?
We won't try. Just a reminder, Market Facilitation Program and WIP Plus. MFP is authorized through CCC authority. It's meant to handle price disruptions or cover losses from trade and other market distortions. So just so we know this, and I think we're safe to say it was never envisioned to be such a large program.
Yeah, I mean, this is not factored into any of the congressional scoring or estimations. So USDA created this out of existing authorities and of their own accord. So this is not this is not your traditional situation. And I mean, to this point, Gary, I don't know that looking back over history, we've not seen this level of agency created, department created payments in history. So this is a whole new space.
So you have to meet highly erodible land requirements and AGI requirements as well. WIP Plus will have also some payments for Illinois farmers, and particularly those who have prevent plant payments. It will top off those prevent plant payments. So those two are important. And there's also WIP for crops, tree nuts, and milk losses. And we don't think that those apply to Illinois farms.
No, this is mostly hurricane and wildfire relief on this side of it, but there is the prevent plant component that we'll look at a little bit more here. This just sort of a snapshot of just where MFP fits in the overall scheme of things, and an idea of just how large these payments are likely to be if they all get made. CBO is telling us that about $9.6 billion has already been made under MFP from the 2018 version of it. What USDA has announced for 2019 is they've said they're going to make $14.5 billion in total MFP for 19 spread across 3 payments. 50% of that is upfront now, or is being made now. And so what we've got in here is the CBO baseline for the 2018 Farm Bill looking out. And then we split the MFP for 18 and 19 in the 2 fiscal years that we expect most of those payments to go out. This is an estimate, but it's, again, just a sort of an indicator of, just the massive amount of outlays that will likely come out of these programs. And just sort of running through MFP a little bit. Here's from the version 1. As we all kind of know, the bulk of that money went out for soybeans. Soybeans had a $1.65 per bushel payment rate. Corn, by comparison, had a whopping penny per bushel, but that's the 2018 version of it. And then if we look down and go ahead and jump down a little bit more. Here is our here's our understanding of this, and this is not a guess. This is what USDA has reported as the county average payment rate. So MFP2, the 2019 version, there is a flat one-size-fits-all county payment rate for every planted acre of all of these crops. So it's basically all the crops covered by Title I plus alfalfa. And you can see the map here in front of you of the variation in these payments. They vary anywhere from $15 an acre in a county to $150 per acre. Really, the difference maker in this, frankly, is these southern cotton counties, in which they've got a healthy payment rate at 26 cents per pound. And you think about this, the more crops you have planted in that county, you're adding up, and so you're going to see that big spread in payments. Soybeans, USDA is telling us that the average rate in the county is determined based on a $2.05 per bushel commodity rate. Corn at 14 cents, wheat at 41 cents, and so they've put out some information on this. There's actually a lot of questions we still have on how this is calculated, particularly these rates. But what we do know is this is the rate per county and where those payment rates break down nationwide. The prevent plant supplemental. So leaving aside the wildfire and hurricane component and just looking at prevent plant. So for those farmers who had prevent plant crop insurance coverage for 2019 and were prevented from planting the crop for which they had coverage, and we've talked a lot about that in the past, and you can go back and find those old webinars if you want to go back over some of those details. Gary's got his maps up there of just where we saw acreage changes and then where we see our prevent plant acres.
So the WIP plus prevent plant supplemental will be 15% on RP. So if you got our understanding is if you got a $400 prevent plant payment, you'll get 15% more, which will be about $60 in that case, and 10% on other policies. And just to clarify that, this is our read of what USDA released. We've not seen actual dollar figures from them for that. The way the provision reads and what they released, it says 15% of the indemnity payment, not 15% of the insurance guarantee. If you remember, your prevent plan is 55% of your insurance coverage. So if you have 85%, it's 55% of that 85% coverage, which you can see the calculation there. And as we understand it, it's not adding 15% on the 55%, it's taking 15% of the payment. And that's where we get this number. And this is an estimate. This is our best read of it. We're happy to be corrected and informed further by USDA if we have this wrong. But the way we read it, it's the indemnity that you multiply by 15% to get to this, in this case, the 5610. WIP also has a crop payment. You can see the formula there, expected value of the crop times WIP payment factor. You see the WIP payment factors to the left, minus the value of the crop, minus the insurance indemnity. We do not think this implies to Illinois. Yeah. So just so we know that. I actually don't know where it will apply, but.
Well, I mean, as the name says, it's wildfire and hurricane are the priority. So where we've seen that kind of damage, particularly hurricane damage, you think Southeast and Georgia and Carolinas. There is some flooding and there are some components of that may come into the Midwest, but we're at this point in time just not certain. What the provision said is it has to be a secretarial designated disaster county in order to have that coverage supplemental. So our best advice, I think, is probably to talk to your insurance agent and just get a sense of what information they've received. But right now, this is our best guess.
Wait a week or two yet. So, all right, there will also be, so Illinois has declared a disaster area. If you do have if a farmer has some direct loans from FSA, there's a possibility of not making or postponing payments for 2019 till a future year. There are guaranteed loans can be restructured. There has to be obviously cause for that, and disaster loans may be available as well. Although I'm not sure that they'll be all that attractive given the interest rate is low interest rates at this point in time.
Right. And so we'll take some questions here as they come in. Some of these we can answer. Again, I want to stress on this prevent plant aspect. We just read it just came out 2 days ago.
Yeah.
So we just read through it and have just started to try to analyze it. So this is a pretty rough initial estimate. We welcome corrections and we'll update as we go and learn more about it.
And it will be, our understanding of it is it will come through the crop insurance companies themselves. So
it'll be treated like crop insurance, or it is a crop insurance supplemental.
And our guess at this point in time is you have to make no additional
right
forms or what,
It reads like it's just going to push out through the system, that it's not something you come in and sign up for or do anything further, that if you had the coverage, you get 15% or 10% based on that. It should be made in, relatively short order. I would imagine crop insurance, since all that information is in. Somebody did ask whether these could be discounted or 50% up front. That's a good question. Congress, this part of the assistance was due to an ad hoc provision that Congress passed in an appropriations bill. So there is a set amount of money available. There's $3 billion total for all of this, for the prevent plant, the WIP. All of this has got a $3 billion cap on it. So in some sense, it will be subject to the potential of a limit. I hate to make an assumption like this, but I presume that USDA had run those numbers before they announced these provisions, so that we don't all of a sudden wake up and find ourselves above the statutory limit. That'd be a problem for USDA and everybody else. So we presume these numbers have that built into it. But you should know that that's something we'll be watching. So we don't know at this point in time. Does WIP Plus kick in for non-prevent plant losses?
And the answer is yes, but for wildlife.
For wildlife, yeah.
Don't know. So if you're in Illinois, no.
Right. You got to remember there's two components of that. There's the WIP, the wildfire hurricane aspect of it, and then there's the prevent plant aspect. The prevent plant is only for prevent plant coverage. You have to have had that coverage to get that top up. A couple other questions. If operator makes ARC PLC decision, what happens if different operator farming in 20? Yeah. So we had this issue with 2014 over the 5-year. That will remain for that year. So once the farm is enrolled in ARC or PLC 19 and 20, it's enrolled in that program, and then the decision can be remade in 2021. So the new operator would start their lease under the decision of the previous operator. This time around, it'll only be 1 year. And given the timing of that sign up, the operator change should not be hopefully too big of an issue for most.
So on yield updating, this current PLC is associated with the farm. So in a lot of cases, it would have been updated in the 2014 Farm Bill. And if it wasn't updated in the 2014 Farm Bill, it could have come from a long time ago, but it's associated with the farm. And you'll be multiplying the 2013 to 2017 average by is these numbers right here. So we've already done the 0.9 times the national yield ratio, and this is the factor right here.
Right. So just to clarify, 0.81 is corn and soybean factor you're multiplying 0.81 by the 2013 to 2017 average. That's what the updated yield would be. Can crop base acres be updated? No, there's no update on crop base. No base update, no base reallocation this time around. Will Ark County and PLC price be the same? Yeah, they are using, we have to be careful how we say this. They're using the same prices in the calculation. They're both using the national market year average price for the calculation. The difference comes in from, in Ark County, you're talking about 86%. The guarantee is 86% of the benchmark. So the benchmark is using the same calculation, but the guarantees are different. With PLC, it's a 370 statutory fixed price, and if the MYA is below it, that's your payment rate. Right.
The benchmark price for Ark County can differ from the effective reference price, and it will do so for soybeans.
Right. Clarification of the policies after the expiration of the Farm Bill in 2018. Okay, so all farm bills are written with sunset dates in them. The 2018 Farm Bill will run through the 2023 crop year. The presumption is that Congress will reauthorize those programs in some form or fashion or extend the current programs before that sunset actually happens. So after this Farm Bill expires, my first take on that is I wouldn't worry too much about that, because the likelihood of what happens technically under the statute is that we revert to 1949 Act policy, which would be 90% of the parity rates on a price supporting loan. The likelihood of ever getting to that is minuscule, because it would be a complete mess in the markets. I mean, 90% of parity is kind of hard to fathom the amount of money that we would be spending on these crops. So I wouldn't worry too much about it. Congress usually either reauthorizes or extends to avoid that problem. I'm hearing PLC is the better choice for 19 and 20. Please explain why. I think we have done our best on that. I mean, we're looking at a lower price scenario that factors into the moving averages of the benchmark for Ark County, which lowers its guarantee.
Yep, and I would caution a little bit. Let's wait till the middle of the year and see what these yields do turn out to be and the price levels are, and then we'll know for sure. So, or no closer for sure.
I mean, that's
just wait till December, but it does look like PLC will be the alternative in many cases.
And that's a good reminder, right? That if we just make the decision on price, it's PLC.
Yeah,
probably. Because you've got that fixed price level, and until we see prices increase to some degree. But what the big difference maker this time around in this decision is where yields might end up, because a low yield and a low price can bring down that revenue sufficiently to get to possibly trigger a payment. Mm-hmm. But if you're just looking at price, PLC is going to be the stronger option, because it's got that fixed price level in there, and there's no other aspect of the calculation. You're below the price, trigger the payment.
So I think the calculator is a little misleading. It shows the payments based on the statistical odds. You should add a line that says the payment based on, so you want to see a yield, price and yield calculator, and we will have that available in the future.
Yeah, and that's again why you wait a little bit to see before making this decision, because we'll have better information, at least for 2019, to be able to narrow the range, narrow the odds around which that payment out there is possible. I think we've run through most of these questions. I don't know. We got anything else? And we appreciate. Thank you for we appreciate everybody tuning in and sitting through this, and always happy to answer other questions as they come in or as we get them. Again, this webinar, we're past our time here.
Yeah, we got to end.
Realize where we're at. We apologize for going over our allotted time.
If you're still here, thank you for sticking with us. Go about the rest of your day. This webinar will be up on the on our website later. Will it be later today or Monday?
This afternoon.
This afternoon. So we'll have this up there this afternoon. We will be doing more webinars. And by the way, there was a question, is there a simple explanation of ARC and PLC? We do have articles on our FarmDoc Daily website. You can judge whether they're simple or not.
And before we go, I just want to make one final big thank you out to our sponsors. Thanks again for that. Thank you to everybody who tuned in, and stay tuned for our next webinar, as we hopefully will know a little bit more by then.
Yeah.
Good luck to those of you out there getting ready to fire up for harvest. Be safe, and good luck with everything.